Welcome to the Deep Dive, where we take the world's densest research and make it instantly digestible. Today, we are peering into the famously opaque world of private equity.
Yep.
Specifically, we're focusing on the buy and build or B&B strategy.
A very popular one.
It is. I mean, if you've tracked PE for any time, you know B&B is hugely popular. The data consistently shows these strategies just deliver superior returns.
Mm-hmm. Better than traditional buyouts.
Right. But the problem has always been the how. For years, how they create this value has been, well, a black box.
That's the perfect term for it.
We're trying to figure out, what's real sustainable operational value versus what's just financial engineering.
Exactly. And at its core, the strategy is often described with that old saying, the whole is more than the sum of its parts.
Okay.
So a PE firm, they'll buy a big anchor investment, that's the platform company, and then they spend the next few years just bolting on smaller companies, the add-on.
Building it up into a much larger entity before they sell it.
Precisely.
And today, we are going to crack that black box wide open. Our sources are using this just incredible proprietary sample.
It's a fantastic data set.
It's 161 B&B buyouts with 971 related add-on acquisitions. I mean, that's so granular.
Oh, yeah. That level of detail lets you finally decompose the value drivers.
So our mission today is pretty straightforward.
Mm-hmm.
We're going to separate the value from true, hard-won operational improvements from the value created simply by the deal structure itself.
And to do that, we have to focus on EBITDA growth. That's really the engine here.
Right.
And this study breaks that growth into three distinct parts we need to track. First, there's organic EBITDA growth.
That's the true stuff. Synergies, cost cuts, real growth.
Exactly. Then there's inorganic EBITDA growth, which is, just buying growth by acquiring the add-ons.
Simple enough.
And third, and this is the hidden piece, is what they call the add-on sourcing effect.
Okay, sourcing effect. That sounds like what we're here for. Multiple arbitrage.
That's the...
All right, let's unpack this. Let's start with the big picture. Traditionally, PE performance gets broken down into, what, 3 drivers?
Yep, the big 3. You've got your operating improvement, which is just EBITDA going up.
Got it.
Then you've got EV to EBITDA, multiple improvement. Sometimes people call it multiple conversion.
And finally, deleveraging, paying down debt.
That's it. So when the researchers looked at these B&B buyouts in the sample, the results were pretty clear.
Right.
Operating improvement is still the king. The total increase in EBITDA contributes the most to the overall equity returns.
How much are we talking?
We're talking nearly 60% of the value. Specifically 58.1% for all the buyouts in the sample. It's huge.
Okay, so that sounds great on the surface.
Mm-hmm.
It sounds like B&B's success is all about rolling up your sleeves and just running the business better.
It seems that way. But then you look at the other parts.
Right.
The multiple improvement contributes about 27.3%, and deleveraging, it's the smallest piece, only 14.6%.
Oh, that's interesting. The deleveraging part is so low.
It is. And what's fascinating is that this is directly tied to the B&B strategy itself.
Wait, hang on. If they're growing the company, increasing earnings, shouldn't they be paying down debt faster? Why would B&B limit that?
Because think about all those add-on acquisitions. All 971 of them.
Yeah.
They're often financed with new debt. They aren't just paying down the original loan. They're constantly taking on more debt to fund the expansion.
Oh, so the total debt burden might not be shrinking much at all.
Exactly. It severely limits their ability to pay down that initial debt from the platform deal. So that contribution from deleveraging stays really low compared to a standard buyout.
So they're making a choice. They're trading the steady, predictable value from deleveraging for the potential explosive growth from those add-ons.
Precisely. It's a riskier, higher octane approach.
And that brings us right back to that hidden component, the add-on sourcing effect.
The core transactional mechanism.
Okay, we've covered the basics. Now for the crucial part, the secret sauce. Tell us about this multiple arbitrage.
The mechanism is, it's both really straightforward and incredibly powerful.
Lay it out for us.
PE firms are buying these smaller add-on companies at way lower EV to EBITDA multiples than the high multiple they paid for the big platform company.
So that difference is the arbitrage.
That's the arbitrage.
So if I'm getting this right, they buy low, roll that little company into the bigger one, and then when they go to sell the whole thing, that cheap acquisition gets revalued and a higher multiple just because it's part of a bigger, better entity.
You've nailed it. That's exactly the mechanism. And the data here is beautiful.
Oh, yeah.
On average, the multiples they pay for add-ons are just 92.4% of the platform's multiple. But the median, The median is even more telling. It's 75%.
Whoa, hold on. The median is 75%. So you're saying half the time they are buying these little add-on companies at a 25% discount or more compared to the platform's value.
Yes. That median shows you this sourcing advantage. It's profound. It's consistent.
But how does buying something cheap show up as EBITDA growth? That still feels like a financial trick, not an operational one.
Great question. So because they're buying cheaper add-ons, it automatically lowers the average entry multiple for the whole combined company.
Okay.
The researchers needed a way to isolate this, so they came up with this idea of sourced EBITDA. Imagine the PE firm buys $10 million of EBITDA from an add-on.
Right.
If they had paid the platform's higher multiple, maybe they would have only gotten $8 million of what they call price-adjusted EBITDA for the same cost.
So that extra $2 million.
That extra $2 million is the sourced EBITDA. It's EBITDA they basically got on top for free because they were such good shoppers.
So it is a transactional gain. It's value created at the moment of the deal that's just masquerading as operational success later on.
That is the ultimate takeaway. And when they quantify it, this sourcing effect contributes 21.2% of the total EBITDA call.
A fifth. More than a fifth of all reported operating growth is just from this multiple arbitrage. Not from synergies, not from running things better.
Exactly. It's sourcing acumen.
So what happens when the researchers, mathematically put that gain back where it belongs?
That's the key adjustment. They take this gain, which contributes about 8.2% to the overall equity value, and they move it.
Out of operations.
And into the transactional bucket, the multiple conversion. And the picture shifts. It shifts dramatically. Operating improvements contribution goes down, obviously, but multiple conversion jumps from 27.3% all the way up to 35.5%.
That is crucial. It really does pull back the curtain.
Yep.
It confirms the playbook is more about buying smart than just running the business better.
And that leads us right to the big question about B&B outperformance. We know it outperforms. The question is the sourcing effect the only reason why?
Okay, so what's the final verdict from the data?
It is the decisive factor. The study found that when they mathematically eliminate the sourcing effect...
Using that price-adjusted EBITDA.
Right. When they do that, the outperformance against non-B&B buyouts just shrinks dramatically. In a lot of their models, it becomes statistically insignificant.
So you strip out the deal-making genius, and B&B firms start to look a lot like everybody else.
Pretty much. The real edge is their ability to find and buy those cheaper targets over and over again.
Which begs the question.
Yeah.
What helps them do that? What separates the good from the great at pulling off this arbitrage?
The study found two main things. First, and this won't surprise you, it's having dedicated sourcing teams.
Makes sense. People whose entire job is just to find those deals.
Exactly. And having those specialized teams has a huge positive impact. It boosts the sourcing effect by roughly 6.3 percentage points.
Wow, that's a massive lift. So it's not luck, it's a professional discipline.
It pays a direct return. The second factor is industry diversification.
What do you mean?
So acquiring add-ons that are in adjacent industries, not just in the platform's exact niche, that also boosts the sourcing effect.
So they're finding cheaper targets in nearby industries where maybe the competition isn't as fierce.
That's what the data suggests. They can capture better arbitrage deals there.
Okay, so we know how the value is created, where the real profits are, and how the best firms do it. Now for the end game, the $100 million question. Once this thing is built and the PE firm wants to exit, does the next buyer care how the growth happened? Is real organic growth valued more than growth that was just bought or sourced through arbitrage?
And this is where we get the most surprising, and I should say preliminary, finding of the whole study.
Just
the composition of that EBITDA growth, whether it was organic, inorganic, or from sourcing, it does not seem to have any significant impact on the exit multiple.
Wait, what? That's totally counterintuitive. You're telling me that the next buyers, who are presumably very sophisticated, they don't differentiate between $1 of real growth and $1 of sourced EBITDA.
That's what the regression analysis suggests. Statistically, they're not applying a premium or a discount based on the quality of that growth.
Why? Surely a big strategic buyer doing their due diligence would spot this and penalize the sourced growth. It just feels inefficient. Why would they pay the same for it?
It's a totally valid challenge, and the researchers are careful to note this finding might be preliminary, but they offer a couple of really compelling reasons.
Okay.
One is simply that the buyer might not have the granular data to really distinguish the sources, though, like you said, most industry experts think buyers do ask for this stuff.
So if they have the data, the indifference must be a strategic choice.
Right. Exactly. Which leads to the second, and I think most plausible reason, it's about the buyer type.
Well,
If the company sold in a secondary buyout, so the buyer is another PE firm,
then they're just going to continue the same strategy.
they're going to continue the B&B strategy, so of course they won't penalize the reliance on sourced growth. That's their path to value creation too. The game just continues.
Fascinating.
So, to just summarize everything we've talked about today, this study really has pulled back the curtain on the buy and build black box.
Yeah, it has.
It confirms that the outperformance is heavily driven by these really sophisticated transactional skills, multiple arbitrage, not just by pure operational genius, the advantages in the sourcing.
For me, the big aha moment is that reallocation of value. For so long, we linked B&B with these massive synergies in organic growth.
Right.
But the data makes it pretty clear that a huge chunk of that is just transactional value, created because they're smart shoppers capturing that multiple spread.
That's it. And this leaves us with a really provocative thought for you to consider.
Let's hear it.
Given this preliminary finding, that exit buyers don't seem to differentiate between these growth sources, what does this imply about the market's efficiency?
That's a great question. I mean, will more transparency, maybe from studies like this one, eventually force buyers to pay a premium for true organic growth?
Or will the black box arbitrage just continue indefinitely because the next financial buyer is just waiting to play the exact same game?
Something critical to mull over as you look at those impressive earnings reports. That's it for this deep dive. We hope you feel a little more informed and a lot more curious.